Welcome back, everybody. Well, as always, we have a lot to go over, and some of the stuff's pretty simple. We can all see the all-time highs right here on the weekly, on the ES, S&P 500 futures. The question really is, where do we go from here? And I think you're getting some clues. Now, one of the most important things for me, as always, is just looking where I am on a weekly chart and then overlaying just some basic oscillators just to see where we are. And if I look at the RSI, I'm not even overbought yet. So the idea that this is setting up to simply roll because, quote, we are too high, and as always, I don't know what that means. You can always see us come back down, but with the data that came out that we're about to go over with CPI, PPI, what's upcoming, historically over the past 100 years when we're in this kind of cycles, we'll see in a little bit here, this is not the worst place to be looking at putting on risk, in my opinion, but we'll get into that in greater detail. Over this kind of move, what we want to do is just see, hey, do we have the rate of change? Is that positive or negative? And what we can see here on rate of change is relatively simple. I'm not really looking for indications of higher highs. I just want to see that the weekly is pointing higher. Now, as always, rate of change. Remember when we were dropping on rate of change here? We don't really care about the dropping. We just don't want to stay negative because if you're negative on rate of change, you cannot go higher. Rate of change is pretty much the simplest oscillator that you can use. If you're below the zero line, you're not going higher. It's very clear, use it on a weekly. If you have these little dips, can those little dips play out? Yeah, they can. If it's declining, the rate of change just might not be going higher, but it doesn't mean that you're going to go down. And what you'll see here is any of these breaks below that line usually gets you some kind of decrease. But if you're just kind of going sideways, it really doesn't matter. It just means that the rate of change is staying stagnant or going the same. I'm not really looking for divergences here. All I'm looking is, I'm using a demarcation line. Am I above it? Yes. Am I below it? No. Also, if it is rising, it does mean that you're probably going higher. Now, there is some seasonality to this, and I'm not a big seasonality guy by any stretch because you always have different environments. But if we take a look at this, we would look at October right along this line, and we would see things pretty clearly, meaning here's, just point it out real quick. We look right down here at that zero line, and you could see what? You could see exactly that is around October, 10th, I think? Then you kind of come in here and you say, okay, that's September, and then you have October 23rd, and there's a bottom there, and then you kind of look here and go, okay, well, that's September 9th, we're not really there, and then but we're really around that October level. We're going to get more into the seasonality here. I'm more interested in seasonality with an election cycle. I think that that's much more important to look at right now, but if we look at these areas, you could say, yep, this is usually where we sell down and then we kind of rally into the end of the year, barring any catastrophes. And you could have some catastrophes out there. We'll get into that in a little bit. Now, this is where it gets interesting for me because the MACD does give me divergences and does give me really clear signals on what's going on out there. And this is the ES, again, on the weekly, and you can just see what's going on here. But I'm going to pick this up for a second just so you can see some. And I've pointed this out ad nauseum. I prefer to see these on RSI, but you can see them here as well where you're looking directly at a divergence. And you can see that divergence pretty clearly here, right? And you can see how we took out that low, but at the same time, we made a what? Higher low down here. And those kinds of events do mean something to me, very similar to how you had this setting up here, and then you had a negative divergence, which then you flush out, you retest a key level, which is what you did, and now you're going higher. And I think that's important. So what I'm looking for here, more than anything from this portion, is I'm looking for some kind of turn. Let's clean this off, get rid of that right now. I'm looking for some kind of turn. So when I say that, I'm waiting to see, are we going to break the DTL on this MACD? And this is something that I do look at. I'd like to run these charts really on a weekly basis. But really what I'm looking for here is, okay, is this an on-ramp? In other words, we seem to be gaining momentum if we take a look at this. And I do look at this, and I look at it on a weekly basis. I don't look at it every single day, but I do want to understand where we are. I will also look at the histogram. But for my weekly run-throughs, it's just, hey, where are we with this? What's going on? And I do look for these crosses because they do tell us something. If you looked at these crosses, you can see areas of interest. And it doesn't mean that, oh, I have to get in or out, but you're looking at there and saying, okay, well, I do have weakness here. Okay, here's another cross. Okay, I do have strength. All right, I do have weakness. All right, and then you're going there and going, we should have what? Strength. right? Sometimes the simplest stuff, guys, is just the easiest to do. So if we run through those there and then just go to the NQ, you're going to see a couple things here that I think are pretty fascinating. Well, I think fascinating. Number one, you are not higher highs here on the NQ, not even close compared to where you are in the S&P, which means you have basically a more broader based rally than a tech rally, which is actually really helpful for the market here. So when we're seeing this and we're seeing what's going on in China, and we're going to talk about the reinflation that's going on there and how we're supposed to market that, or how we're supposed to trade it would be a better way of saying it. I think you have to look at this and go, okay, well, what do we have here? Well, we have the undercut that we're all aware of. We have this drop, the shake and bake, as we like to refer to it. You have really this beautiful piercing pattern where you undercut, tries to lift, and goes from there. And if you just look at the simplest of things again on the NQ, you're nowhere near overbought. So the idea that you can't push here, it's just not realistic. And again, what we want to look for is the rate of change going higher? And the answer is yes, it is. Now, is it making these higher highs that the ES is making? No, that's actually good. Because it means we're not getting frothy. But again, I don't really use it for divergences. I just want to see what are we doing? Are we going higher or lower on the weekly? You can actually set your watch to this stuff. It's crazy. If you look at this ROC and you just look at it weekly, once you flip, as long as you're above, you're good. Whenever you start getting below, that's when you run into problems. So I would suggest that this is something that you just add to it. It's just rate of change. I didn't do anything weird to it. I didn't change any of the monikers and how it's calculated. I do that with some of the oscillators and indicators, and I usually tend to point that out. But this is setting up very nicely, and we have real leaders. Now, as I want to point out, we've been talking about IGV all week in those pre-market public videos, and I would suggest that you tune into those. If you can't watch them, I keep them all. They're live. Just make sure that you subscribe to the channel, click all notifications, and you'll know when I go live. We shoot for 8 o'clock. Sometimes it's more like 8:15 if I need another cup of coffee before I start. But it's not just me talking either. It's a lot of people throwing out ideas, and I find that very helpful versus me just regurgitating all my information, because I don't have all the greatest ideas, and other people do have great ideas. And so by putting those out there and then talking about them, I think that's what makes that pre-market video so much different, so much better, quite frankly. I've been doing this 25 years. I learned a long time ago, I don't have the best ideas, right? You want to find out who's got the best ideas, and then you want to make them your own and put your own spin on them. Anyway, IGV weekly right here. That is about as technical a breakout as you can get, guys. Like if I was going to create a book and write a book and I wanted to show you what a technical breakout looks like over a monthly base, that's what it looks like. Now, I don't think people get this with IGV and what's going on there. So Ellison is now the world's third richest person thanks to the AI boom. This guy's 80, looks like he's 40. But toppled Bezos on the rich list. Now, this is pretty fascinating stuff. Now, fueling Ellison's good fortune, demand for data centers, unprecedented demand for data centers. So if you start thinking about what goes into a data center, and where do you see the numbers in the skew here? It's fascinating. OpenAI. So let's go through why do they even want there. Which powers AI models underpinning products like OpenAI's ChatGPT. Oracle beat Wall Street's expectation earlier this month when it reported 7% year over year, $13.3 billion, accompanied by cloud service skyrocketing 21%. The news has been a booster for Oracle's share price, 47% in the past 12 months and almost doubled since the beginning of 23. This OpenAI is the reason for all of this. And when you see why, and there's a very clear reason as to why, it becomes very clear how this is going to go. And IGV is at the center of this. Now, one of the things here about data centers, and what I want people to kind of wrap their mind around when we start talking about the IGV names, is Oracle currently has 162 data centers under construction globally. Ellison told analysts at an earnings call, and he did this at Oracle World as well. If you look up Oracle World on YouTube and listen to Ellison's speech, just Ellison Oracle World speech, listen to what he has to say. Adding expects the company to eventually have 1,000 to 2,000 of these facilities. So I just want to put this in perspective when we're talking about IGV, or I've been talking about NVDA now for 2 years on this, and everyone's saying that this is going to be a fad. Okay, they're at 162. The third richest guy in the world's telling you that they're going to have at the low end 1,000. Okay, that's 9x or 18x. Okay, so do you think that people are going to need more NVIDIA chips? Now, why is this all going on? This was the best graph I could find to illustrate it. It's why the reason anything goes on, money, okay, for no other reason. And I hate to be that callous about it, but that's what's happening here. OpenAI revenues exceed Google at the time of the IPO. So if you sit here and take a look at these thresholds of Google or Meta, and you look at where OpenAI is, and people saying, I can't believe they got a $150 billion valuation. And what I personally think with this is I think this is why you saw people drop out. But we'll do that in another video, why they dropped out of the OpenAI investment round.
This is why everybody wants the best large language model. Now, is it going to be OpenAI? Is it going to be Google, Meta? Who's going to have the data centers to do this for this kind of computing power? And it's very clear right now that they want what OpenAI has. So they want to be able to have these data centers. It's very clear that this is money driven. I would not sleep on this. Now, one thing I really like to do in these videos is to give actionable tips. And what I would suggest that you do, and you could even screenshot it, save yourself a lot of time. Top 20 names that are in the IGV are right here. I just have this in TradingView and you can sort it however you want. But if you were to go here and just kind of look at what's going on in the world and start clicking through these names, it's pretty clear that you have some just absolute monster moves going on out there, and you have huge demand all of a sudden in the sector. You can see crowd looks like it's about ready to fill that gap in here. And you just kind of go through them all and just see what's going on out there. I mean, it's not one name, it's all the names. As a matter of fact, that when this stock moved out of this rip, Goldman came out and said that their earnings for the quarter are grossly underestimated. But it's not one name. Now, we also have what's going on here with the current hack, and that is lifting IGV as well. Some of these names, I know Cyber's not in there, but I keep that in there anyway. But for me, looking at these names, looking at these breakouts, watching these earnings moves, and then watching them lift higher from those earnings, I think you'd be remiss to not be looking at these names. And we have other drivers in the market as well. I mean, we can see what's going on with China. That is a clear driver. And we're seeing that pretty clearly here. China's whatever it takes moment. Do they do what they need to do? You see this Thursday night. Here's the thing. You have a meeting that's going on this weekend. It's supposed to be a big one. Their Ministry of Finance is the one that makes all the decisions. A lot of people thought it was going to be this other division, and that's just simply not the case. Now, what happens here is on Tuesday, people thought they were going to see this huge move, and it didn't happen because the NRDC, that's not their job. So people are referring to this planner that came out and said the actions are smaller. Well, it's not up to him to make the decisions. It's the Ministry of Finance. And what's happening here is we have a lot of people that really don't understand how China works, making moves in China names. This is a huge, huge disparity between what is happening and what people think is happening. And that's why there's going to be some outsized returns here, either up or down, because we just don't have the type of information that we usually have. The important thing is their target is 5%. Their goal is to get ahead of the U.S. If that is their goal, he has been very, very clear about that. There's no compunction on what he's trying to do here. Confident authorities are ready to deliver major fiscal stimulus, highly anticipated event. That event is going on Saturday. At the time of recording this meeting has not been done, but they're 10 a.m. on Saturday, intensifying fiscal stimulus policies, risk of missing full-year economic growth. Confident authorities are ready to deliver major fiscal stimulus. You never know. You never know what they're going to do, but this is definitely a driver. And there's some interesting statistics here. Now, again, this is what's fascinating to me because this is directly from CNBC. And during the event, the chair, NDRC, pledged a raft of actions to bolster the economy, but stopped short of announcing any new major stimulus plans. It's the Ministry of Finance. And this is what I'm talking about when you have those moments of, I refer to them as reflexivity, where everybody thinks that this event is going to be here and this is going to be the outcome, right? And then this becomes the outcome. And then everybody down here is thinking, oh, okay, well, that's the outcome. And it wasn't as great as we thought. But there's a group of investors that will understand that, oh no, I know that it's going to be Saturday that these changes could happen. And this is really the outcome up here. And meanwhile, the other people are out of the trade or thinking nothing's going to happen and then wonder Monday or Tuesday why they got whipsawed. That's the difference here. This is why I always preach, please understand what you're reading. In this case, my opinion of this is that they're not either understanding it or they're not explaining it accurately. One of two things. Now, what happens on Saturday remains to be seen, but they are at their whatever it takes moment. So I do agree with that. If they do not do anything that they need to do to really stimulate the economy to get this higher, then what you're going to have here is you're going to have a bunch of people that are going to go, here we go again with China, and they're not going to do what they say they're going to do, and then we just get out of the trade, and then you'll see a bunch of people just very simply get out. So this is a really important meeting this weekend, and I would watch the China names on Monday. Now, one of the things they're trying to do in China is they're trying to focus on buying stock back because companies just stopped doing it. But take a look at this. You're at pretty much 18-month lows on buying stock back. You may have 1 month here. So if they are giving capital to buy their own stock back, yeah, it's definitely something that's going to move the company higher. There's no question that it's definitely going to move the market higher, move these companies higher. This graph was done by Jeffrey. And I think they did a really good job. Let's talk about CPI and our U.S. economy and what's going on there so we can understand all the moving parts. And I want to preface the significance of this.
This in front of you is when we had rate cuts, and all 4 of these rate cuts did not lead to a recession. These were your last 2 rate cuts that happened, and some people would say this did put us into a recession. Technically, it probably did, yes. I still think you should keep it as a moniker there, but you still have 19 as well, which we did very well before the pandemic, and we can go from there. This is very different than the people pointing at rate cuts here and saying, oh, well, this is exactly what happened in '01 and happened in '07. These were recessions. If you do not have a recession and you have rate cuts, there's a 100% chance based upon statistics, and I know we need 30 data points for the statistical significance, but this is all we have, that the market goes higher. And that's why this next part of this video is so important. Now, before we get into CPI data, I think it's important to understand why do we care so much about data right now. A lot of people, when I talk about the stool and the macro and then the fundamental and the technical legs and how we have this stool and this is where we trade, they don't understand the importance of why we care about macro. Why do we care so much? We care because it tells us where we're going. Remember, macro is what, fundamentals are who is affected by the macro, and then technicals tell us when to get in, and all of that makes our little stool appear. Now, the important thing about that stool is sometimes you're leaning on the macro, sometimes you're leaning on the technical, but all 3 legs still need to be there. And that's what makes it successful. So what we have in front of us is a graph that you have seen before, possibly. I've shown this a couple times, and I'm going to keep showing it until we're through this period. So we have the first Fed cut. We're all aware that we have our first Fed cut. And then we know 2 months later, we can see the disparity. Now, what do I mean by we can see the disparity? You can see that, hey, do we have a recession or don't we have a recession? So if you go from 2 months over from the first cut, you will start seeing a disparity in the market. It does not happen right away. The majority of people are out there saying, oh, if you cut rates, you're clearly going to go down. That's not the case at all. It's actually the exact opposite of that. If you go back and look through 1984, 1987, 1995, 1998. Okay. Usually what they're referring to is '01, '07, and you had some significant signs there of what? A recession. So what we're doing with the data is we're constantly looking at the data and saying, do we have increased productivity, which is going to lead to this? Or do we have signs of a recession that are going to lead to this? Now, whether or not we get into the data and whether we believe the data or all that, all we can do is what we have in front of us. That's all we can do. So we want to mark from here over, and then we just want to look and say, okay, well, we've been trucking through this now for a couple of weeks, and so far, are we in this camp or are we in this camp? Meaning, are we in the economy camp where, hey, things look okay? Or are we in the camp of, well, we look like we're heading into a recession? And again, you can see how they have the current movement right here and how we're acting. What's interesting about the current movement right here is if you look at the green, which is us, and you kind of look at the blue from before on the previous, we're actually following parts of that pattern. And then if you look at the gray, we're actually following parts of that pattern too. So it's not very clear, but as we're getting into this, it's getting much clearer. This data is starting to look better. It's interesting because if you're in Europe, it actually takes about 3 months. So once we see us come out of it, it actually gives us an edge, but we're going to do that in another video. I do think this is very important that you understand why we care so much about the data that is coming out right now. The second thing that we must understand is where are we during an election year? And I think this chart just does such a great job of this. So here we are, and what they've done here is compile 100 years of election. So they've taken every election and they've taken the S&P and they've averaged it together, and this is what they get. Now, again, if you're in the community, so this a couple of weeks ago and we talked about this, but October 2nd, okay, that's when this graph came out. And now we are in a position where we would say, well, by October 21st, it's over. So somewhere between October 5th and October 21st, over the past 100 years during an election cycle, you have a bottom. And then you go from there. Now, if you look at this graph and you said, okay, well, I'm going to take this line and I'm going to divide the line in half, and that's going to get you to what, right? So you're going to just take these two numbers and say, yeah, that's going to get me to the 12th, let's say, right? Which is right around where you are right now. And again, just to make it simple, all you would do is just take a little bar and we're just going to eyeball it and drop that in. And you would say, okay, well, there's the 12th roughly. And that's telling me that we're probably, for the past 100 years, we might be on the tail end of this. So we might see some kind of rally and then we might kind of come back. But what don't you see over the past 100 years? Consistently, if you take this as a composite, please listen to this, you don't see a lower level. As a matter of fact, what you see is here we are. And then what happens? No matter who it is, for the past 100 years, you go up. It doesn't matter. I know they all want us to believe that the sky's falling. But no matter who it is, once we have certainty, once you have that certainty, you can make more informed decisions. When you can make more informed decisions, you put capital to work. So we need to understand where we are. I feel that we're in this area right here and that we could start seeing some relief into it as it starts to shape up. Maybe we do see this. Maybe we see that panic the week ahead of time where people are trying to position themselves or not. But no matter how you slice it, I do feel that we are in this little box of an area right here. And I think that's important because it's not an area that you're going to stay in very long. You're going to come through this and that's going to be the end of it. My box got a little short there. Now it's all broken, but it is what it is. I'm not going to have time to edit that. You're just going to have to deal with my broken. So November 5th is really where you see that you come out on the other side of that. And then again, just look at the numbers here. It tells you historically how to look at that 108 to 111. It's not like this huge move, but nonetheless, it's certainly not taking out lows, which is roughly what we probably just put in. Now let's get to the fun stuff. Let's get to the data because the data told us a lot. So core inflation is without food and energy. Just so we know, month over month, the consensus was 0.2. Previous was 0.3 and the actual is 0.3. Now this is good for a couple reasons. You are reinflating. Now you'll say, well, why is that good that inflation hasn't gone away? Well, it didn't creep up. It stayed the same, but it stayed the same, which is okay. So we have demand, which means that if you only have demand if you have increased productivity. So therefore, is anything here showing us signs of recession? Now, go back to that graph we just went over. Core inflation year over year, 0.3 to 0.2, right? So there you are again, 3.3, 3.2. Inflation month over month, looking for 0.1, came in 0.2. So again, we don't see anything here at 2.3, came in at 2.4, previous was 2.5. There's nothing here that we would concern ourselves with. Now, this is something that I think raised some eyebrows on Thursday and we should just talk about because we have to look at the data for what it is. Are we seeing signs of what? Anything that's taking us up? Or are we seeing signs of things that are taking us down, right? Because that's going to determine recession or increased productivity. We want increased productivity if we are long. And you see that 258 right there? 230 was the estimate and we're higher than expected and continuing jobless claims are up. Okay, you had a hurricane and now we just had another one. This data is going to be skewed and I believe that's why that data was thrown off. The other thing that I would say is if we were looking for a moment where we were going to have a problem, we should have had a problem. Not on the short end. You always want to watch the bond auctions now. I know you guys hear me talk about this a lot, but you definitely want to watch, are they buying bonds? The short end, they 100% are buying bonds. Look at the long end here on the 30-year, that 404, like right here, 401 to 439. Like that's a huge difference. So if they were really concerned about rates, why did the market drop? It didn't. The market didn't drop. Also, please note that the Fed balance sheet is staying the same. They're not selling anymore. They stopped selling. So they are no longer putting pressure on the market right now or on bonds, and you're staying the same. So if I don't care if they buy, I would prefer that they didn't. I'd prefer to have a free market. But what we don't want is them selling into these cuts as well and creating more issues. So I think that this is really important that they're holding steady. Now that takes us to the next part of this, which was Friday's PPI number and also what Michigan Consumer Sentiment had. Month over month PPI, 0.1, 0.0. This is going to scare people a little bit, and that's okay, but it does do something. Understand that PPI is the producer's price index. When you go and buy a burrito at your favorite burrito stand, they have to go buy those tomatoes and eggs somewhere and then sell them to you. This means they're paying less. We're paying a little bit more, which means corporate profits are going to be up, right? If they're paying less for product and they're selling it to us for more, corporate profits are going to be up. Now you look here, 0.2, core, 2.7, 2.8. That's up, but month over month's down. And then you go to year over year, 1.6, 1.8. So again, you would think that this would have dropped, but or something in line with that, but it didn't. Now, how's the consumer feel? 70? Okay, that's where they were. We're at 69, not the end of the world. The consumer feels that inflation is dropping over previous, so that's good. Consumers' expectations right now are supposed to be 75. We're at 72.9. Nothing crazy there. Current conditions, 64, 62. This is pretty low, but it is what it is. The important thing about this is nothing really hurt us, but this number actually helps corporate profits and also will also skew the chances of a rate cut and make people be a little bit more cautious than just saying they're never going to cut rates again, which you had a lot of talk of, and we can get into that now. Now, one of the things I would say to you, in 25 years of trading that I have not seen anything like this, I've never seen so much volatility on are they going to cut, aren't they going to cut, how many chances are they going to cut? I've never seen anything like this. It's usually we have a trajectory, we follow that trajectory, whether that trajectory is up or down. Never in history have we raised rates this fast and this much. Neither have you ever raised them this much, and neither have you ever raised them this fast. And that's really important to understand. But if we look at where we're at right now, we are at 475 to 500 as a target. After that target, there's the ease, 95.6. Chances of no change now are 4%. This is where it gets interesting to me, because a month ago, you had a 45% chance that this was going to be the carry. Then, last week, it dropped to 2.6. Yesterday, there was a 16.7% chance that you were not going to have a rate cut. And today, there's a 4% chance. Why? The Michigan consumer sentiment data, okay, that was a little weaker than expected. PPI, a little weaker than expected. So now we've gone from an 83 to a 95% chance that we're getting a rate cut. But the chances of that rate cut being 50 basis points are zilch. There is no chance that you're going to see that. But now you have a 95% chance of that rate cut coming in November because of what happened today. It is so important to continue to watch the data the way that we are right now, because this is going to greatly affect whether or not bonds go higher or lower and whether or not equity prices follow. And if we just follow this theme out to the end of the year, 475, 500, 450, 475. 450, 475, there is a 15% chance in December of that. Well, there was a 14% chance previously. So it's kind of interesting that the probability of being here is pretty much the same as November. And there's an 84% chance that you are going to see something more by then, right? So now they're saying, oh, there's 84% chance we're going to be there. And you can see the skew. A month ago, you were saying, well, there's a 46% chance, then there was 80, then you went down, and now you're back up. But these 50-50, that dream is dead. We have a 25-25 being the base case now. And that's very important to note. Now, I want to point this out because people, when I went through this in the public pre-market, which I would recommend that you watch, they usually start between 8 and 8:15 every Monday through Friday. And I started explaining how to actually use this data. You can actually see it month over month. If you type this if you just Google it or you search anything, you'll find it. And what you're looking for is you're looking for the extreme readings, and it will tell you from those extreme readings what's moving, what's not moving. Once you have this, you can actually drill into this data. And down here, what I always look for is the wildest moves. What's expanding the most? And I would just suggest, do you want to buy gold or do you want to buy eggs? Because if you look down here at the bottom, eggs are moving. They are moving pretty rapidly, and everybody needs eggs. A matter of fact, when they break it down line by line per any item, nothing is moving faster than eggs. And you can profit from this. See, once you understand what this data is, this is why I always hammer home, what are we looking at? Because once you understand what you're looking at, you can see the difference. Look at this moving column. Now, they are the single largest distributor, period, in the country for eggs. And look at what this stock's been doing. It's absolutely exploding. Why? They have pricing power. People want eggs. And you can see this lifting up. When you see this, it tells you like, oh geez, maybe I should go look for other companies that do what? Sell eggs. And then you come here and look at something like VITL, which is also in that space. You can see here how it broke the 55, how it's respecting the 12 and the 22, and how they're all lined up perfectly. I use a 12, a 22, and a 55. And once you flip this, that's a really big deal to me. As you guys know, I am a pattern trader, which really brings me to something. I really want to thank you guys for your comments about, hey, show us more swing trades, show us more long-term trades, and how you're getting into those ideas. And I'm doing just that in this. Take a look at this. If you've been following this channel for some time, you know that I am a pattern trader. I do look at everything, but at the end of the time, it becomes an issue of when. This pattern is called the dragon pattern we're about to walk through. And usually I would save this for a separate video, but this is a very specific pattern that you don't see very often, and it's triggering in two names. The reason I'm covering this specific pattern is your comments about show us things that you do for your swing trades and long-term trades. And I'm about to show you this. Keep an open mind when you say it, but this is something that you do not see very often. And when you do see it, you want to pay attention. There are several parts to this. There will be a head, there will be two paws in general, or legs, and there will be the tail. I'll show you exactly where you're supposed to enter, what needs to happen for this pattern to be complete, and then what your target is. It's very simple. It's crazy how accurate this becomes, and I just really think it's a process of human nature. But take a look at this, and we'll get right into it here. Now, in front of you is NVDA, and I took off the logo here for a couple reasons, which would be able to right up here as we put this together. So this is NVDA, and most people would look at this and say, okay, well, you're making this very particular pattern. You tried to get back over here, you weren't able to, and now you're finally able to. It's more than that, and there are several parts of this pattern, so let's just mark them. There is the head. Now, the thing about the head is it can cannot just be up then down. It actually has to look like a head, like it has to have consolidated, tried to get above, and go from there. Most people want to use the high. You don't need to use the high. What you need to do is just use the area that looks most like you would think it should look. And so what you're seeing here is you're seeing a consolidation, you're seeing a rally over a previous high, you're unable to do it. We get a rejection right here. This part forms the head. Now, the one thing about this pattern and why I look for it is because it's got a high degree probability of using. You can back test this stuff all you want for yourself, but again, this would be our first area right here, and this area is the first pull. Now, what you do with this, what I like to do with this is relatively simple, and I'll show you why I do this in a little bit. But what I do is I measure it down from here, and I just want to look at the channel. So you can see where this is going, hopefully, but you're looking for these channels, and what you're doing is you're looking for some semblance of consistency. And you can see the head right here, you can see the reversal, you can see how we popped out of this and popped right back in it, giving us that first pull. The next part of this trade is what you're looking for is a slope. You are not looking for up, down. Now, if you look at other patterns of other names, you'll see like that up, down pattern. That is not what you're looking for. You're looking for some level of consolidation that forms a slope. That slope is going to give us the body. Now, it's important to get this. And it's important to understand that that's really what you're looking for. You're looking for that body and you're looking for the hump. It's really important that it looks like a hump. You'll note the difference between what a W pattern would look like. And W patterns, yes, they're powerful. They don't have the same degree of momentum when they get going as a dragon pattern. And there's a reason for that. Usually W patterns blow it out already on the way up. So they've already exhausted that momentum. That's not the case here. And if you want me to show you the difference in what I mean, I can do it in another video. Now, the second part of this is going to be what we refer to as the second pull. Now, you do like it if it's down here. If it's down below this, it's better, because it gives you that confirmation of what people even refer to as that double bottom. You're not getting that. And when you see the completion of this, you'll understand why we're spending time on a Saturday for you to get this and why it's so important. But what we're looking for is we're looking for that undercut. Sometimes you get it, sometimes you don't, and you can only deal with what you have. But once you see this right here, okay, this is very important because you do that and that develops what? Second pull. Now, once this is all developed, what we will do is we'll be very specific about where the entries and exits are. And if you're in the community, you're going to know where a couple of these entries already were. But there's more than one or two. But let's get to it. So now you have the head, you have the first pull, second pull, and here's your body. Head, first pull, body, second pull. Here comes the tail. Now, this is an important distinction. The tail starts above the body. The tail does not start above the head. It starts above the body. So if you were looking right here, then that tail would be coming straight across and it would start here. It's not going to start there. And that's going to be an important distinction in a second here, and you're going to see why. But again, what we're always doing is we're always saying, okay, well, where does that start? Well, it starts right here, and that gives us the tail. And all I'm going to do here for consistency's sake is just make this a little bit like that, and you can understand where we're going with this, hopefully. So these are the parts of this. You have a head, first pull, body, second pull, tail. All right, let's talk about entries for a second and exit so that you can get this. Now, your response in looking at this is going, that's great, you drew a dragon. And we both know I don't have the ability to draw. But let's get to this. Why is this so important? The very first thing that you want to do is understand where your entries are. And for me, there's always two. Okay? The first one is second pull. I'm not waiting for this. When I see this development, it's not very common. You're not going to go through a lot of them and find this, especially on daily charts. And I'm doing this. You can do this on 1 minute charts, 5 minute charts, any time frame that you want, you can do this on. Your comments were about show me swing trades, show me long-term trades. And so I'm going to show you exactly where we entered a trade that we're still in, and we've been adding to it ever since. And I'm going to show you where you would even add to this and how you would look at it. This is your first entry right here on 9/11 right here, okay? And the thing is, here's your pull, your second pull, you broke down, you reversed over right here. So this whole section, you're over it. Once you're over, that's it. We actually entered a swing trade here, and we actually entered options here as well. And just for timestamps, I'll just show you the dates on when we actually added to this, added options. And since then, we've been adding to this again and again. And is there another reason I added to it? There is, and I'll get to that, but I want to stick to the specifics of this. So once that second pull is formed, you're not waiting for the body.
you're just buying right in here because this reversal, this Paul, head, first Paul, body, second Paul formed, you now are starting to begin whether or not you're going to have a tail. And you don't know if that tail is going to be the next day, or you don't know if that tail is going to be like this. You don't know the velocity of, but you know that that's there. Once you know that that's there, you start looking for other exit points and you start looking for other entry points. To me, the next one is the head. Now, some people will use the body and say, when it gets to the top of the body, I want to get out. I personally don't do that. I actually use this as an entry. And if you're in the community, you know this. But for point of reference, I just want to show this. You can see the 10-8 timestamp right here and how it correlates with us flipping that body. What I'm trying to show you is that I'm actually practicing what I'm preaching here. I'm actually doing these trades. This is something that I actually do. I've been adding to this, and there was actually another spot to add to it as well. We'll get into that. I can get into more advanced techniques with this if you find this helpful. Right now, what I want to do is give you the basics on where you should be looking at entry. So people will scale out when you reach the top of the body. That's where I add. Now, the other place that people will tend to scale out is the top of the head. When you get to the top of the head, which is 136.15, and you can come here today and see that you got to 135.78 or something like that, and you stopped right at the head. A lot of people will scale out there. They'll take a piece out of it. And that's fine. That's up to every individual how you want to trade, but that's usually what they're doing. Their first exit is here. Again, this is a swing trade. You can do this on any time frame. But to me, I'm doing this on swings, longer term swings, and things I'm trying to build positions in. So I'm adding here, and I actually added again in this particular case when we came back to the top of that movement. I added to this. And if, I can pull out different timestamps. I'm not going to do it all. But I want you to get the process of when you come back and retest the breakout of the second Paul, when you come back and retest the break of the second Paul, okay, you might want to listen to that again. That's where you're like, oh, I missed it. Just wait. You always get another shot. Always. You just have to have patience. So here's the tail. So then the question becomes, that's great. How do you measure what the move is? So this is how you pick your target. You take the head and you go from the head and you measure down from the head to the bottom of the first Paul, and you're going to get a number. And that number is 43 points. You do not care about the number. You care about the percentage. So I'm going to say this again because this is a really important concept. You don't care about the number. You care about the percentage of move. Now, why these things are so deadly and why they're so important is because when they do this, you're building. It's a slow burn on the way up. Okay, it's not this huge velocity move. If you ask anybody over time, even about something like NVDA right now, they're like, "Oh, it's back to here." It's just it's very slight if you think about it. Most people don't think of it that way, but it has been. If you realize how long this took, and that's fine. That's what you want. You want it to build because then you're not getting overextended. And this is why these patterns are so deadly. You're not overextended on any of your oscillators. RSI, rate of change, MACD, none of them, if we went through them, are going to show that. So then you have that measurement down, and we're going to do it one more time so you get it from the top of the head to the bottom of the first Paul. Even if the second Paul is lower, do the first Paul. Even if the second Paul is lower than this, which it can be, do the first Paul. You're going to get 32.94%, let's say 33%. So our target on this move is when this is over from here. Now, again, people will take a profit right here. Whether they're taking 20 or 80% or the whole, it's up to them. But from here, you're looking at a 33% move, okay? It's not a small move, guys. You're looking for a really big move here. And if you go and take a look, quite frankly, now in what you're seeing in the option sweeps, it's starting to fit into this level. Go look at March option sweeps on this. But what this is telling you, and it's not telling you by Tuesday, right? Don't go out there and YOLO. What you're trying to do here is you're trying to understand that this is a long-term trade idea. Like this could take 3 to 6 months to get back up to a level like this, or it could never get there. Sometimes things don't work, but that is your target, and that's how you identify this target. Now, once you see this pattern and you understand it, and I'd recommend that you either screenshot this or save this video just so you have it, you start to look, and then you'll start to see it in other places. For example, in front of you is Broadcom. And if you look at Broadcom right here, you'll see it. You have your head right here. Comes down, this would be your first Paul. Here comes the body. Here comes the second Paul. Once that second Paul is confirmed, right in here, it was on and it never looked back. You'll note that I'm not showing you moving averages. I'm not showing you volume. I don't care. But what you're looking for is these emphatic moves that define the bar. And it's very easy to see. If you're looking for some kind of guide, use 2 times ATR. It's a great way to say, is that a really big bar? Does that bar matter? Just use average true range and times it by 2. They're usually around there. It doesn't have to be exact, but if you're trying to say, well, how do I know if it's really confirmed? Look for a bar that does that. When you see that, you're there. So you would have something like this here where you have your head right up here, okay? And then you would know right here that that's first paw, and then you would know that second paw, and you would know first, let's do that, the body, and then you would know that that's second paw, and then you would know once you flip the body, what starts? The tail, okay? Not when it flips the head, when it flips the body. Now in this case, it's very similar. But if I'm going to measure this out, this is where we would enter, okay? This is where some people would trim at the body, and most would take a price right off of that head as well. And then what you would do to understand this is you would measure from here to here to find the true move of this particular pattern. And it tells you it's around 27%. You would not take the numbers, you would take the percentage. That's really important. A lot of people do this wrong. They take the numbers. Remember, 40 points up from here is very different than 27%, okay? It's a big difference. So if you go there, let's just take that to 27, and you'd be looking at a target of right 225. At the time recording this, I have positions in NVDA and I have positions in AVGO. And one of the driving forces for those positions is the pattern that you're seeing in front of you. If you want to see more like this, comment below. I got asked a lot about swing trades, a lot about long-term trades. These kinds of patterns, when you see them, you start not being able to unsee them. And they are the types of things that can keep you in a trade and let you know exactly where your stops are. You could see exactly that your stop would be below second paw. Like if you broke that, you would just very simply get out of the way of the trade. There's your entry on the trade. And what's great about these, once you learn them, your entry versus your stop versus the potential is staggering, because you're really entering here and saying, all right, if my first target, like for example on this, my first target, if I bought once this paw becomes definitive, right, I would use the low of that, okay? So that's going to give me $13 stop, all right? And again, your stops have to be much wider if you're swing trading or long-term trading. Your first exit, if you were going to use the top of the body, which I don't, is $24 or 2R. Really, it actually boils down to 2 to 1. I don't tend to use that, but I use the high here, right? So that's going to get maybe 26 or 27. Doesn't really matter what it is, right? 28. So you're 2 to 1 over here, okay? Do that all day long and be right 50% of the time, and then be able to leave yourself a kicker on the rest of it, and you won't have a worry ever, right? I mean, if you can hit 2 to 1 50% of the time, you're solid. So what you're doing is then you're getting in a low risk entry for something that's very long. If you did this trade on September 10th or 11th or whenever in here, whenever they trigger, you've been in this for a month and you really have never had a worry. So I would strongly suggest that you look at this. I'm more than happy to go through more of these kinds of patterns and more of these kinds of examples, which are real examples that I actually do in the room and that we go over and that we teach. So if you have any questions about this in particular, you want to see more of it, just let me know. Let's get back to it. There's some names out there that are really setting up for a move that I want to go over. Again, it's your comments that create that kind of content. So when you want to see something, you want to learn something, that's why we're doing this. So hopefully that was helpful. It should be, and we'll go from there. But we started this going with IGV and then why we're starting to look for these sectors. IGV tends to lead. Now, it tends to lead the SOX, which is really good because if you think about it, you start to need this product as well. Let's just convert this to line as well and take a look and see what's going on here. Now, if you go to 24, what you'll see is complete outperformance of the SOX to IGV. And let's clean all that off for a second. And that's really kind of what you want to see, right? But see this disparity that's here right now? This is a pretty big disparity if you go through time. And obviously the further that you go out, you're going to see more of a convergence. And when you see this kind of stuff, you do want to pay attention to it because it does mean that one of two things is going to happen, right? Either SOX is going to roll or IGV is going to wind up catching up. And I think we're in that stage where people are going, okay, there's certain names in the IGV that we need to pay attention to. And again, you can go through the entire list, but it's pretty clear what they are. So when we see these kinds of flags and breakouts, it's very hard to ignore that you've been going up for straight 5 weeks and then you had the wick up here and now you're closed over that wick. These usually leads to larger pushes. And I think that that's important because people are going to look at these charts and they're going to say, oh, it's too high. I never understood what that meant. It's too high. So I can understand that you might not like the valuation of something,
But stocks don't really move on valuation all the time, do they? They kind of move on fear and greed. And I think if you think about it from that perspective, instead of saying why something shouldn't be happening, and you just kind of trade what is happening, sometimes you do a little bit better. So if you look right here, you're setting up here on now, and it's just name after name like this. Even some of these beaten down names like MDB are starting to set up again, and everyone's fan favorite is Snow. And you're actually seeing that starting to bottom here, and you're trying to get through this key level. What's important about Snow, for those that love this name, if you just look down here at this bottom, you're not breaking that level. And the fact that you tested that had a really, no other way to say it, disgusting quarters, and you're holding now, might mean that you're a little washed out here, which is exactly what you're looking for. So you can see some kind of movement here. But you are seeing this movement everywhere across the board. For example, names like PLTR, a lot of people love this name. It's a fan favorite. But you look at this break, it was very, very clear breakout. And then all you've done is consolidated. And people are like, oh, it's too high now. It's not too high now, right? You're having this entire change of trend where you're having this new theme come out and people feel that they missed it. I would refer to that 95, 98 period where people felt that they missed it. And then when they came through that period of time, there were names that did come back around. A lot of people don't remember that Amazon, lost 98% of its value during that crash. Now, I'm not suggesting that you hold something for that, but understanding this, okay, and understanding this, oh, I missed it, is probably the two worst words if you're a swing trader or a long-term trader that you can say to yourself. Okay? This is when the company actually went profitable back here. This was the first time that they were profitable. Okay, that was $21. You're at $188 now. So if you consider yourself a long-term investor, and I got a lot of comments to go over longer-term thinking and longer, that's why we went over that specific pattern today. It's really hard to look at these names that are happening right now, such as Oracle, and saying, oh, I missed it, it's too high. What you want to do is understand the theme and then try to figure out what inning of the theme you're in. I would suggest that you maybe you're in the third inning, but I don't even think you're there. So if you remember that one graph we showed where we were talking about why Google, why Meta, when they first came out, OpenAI is making more revenue than they ever came close to. That's a big deal for Techland. And so when we see something like Meta, what people don't understand yet is that that's why they're putting so much money in CapEx. There's a race going on for who's going to have the best large language model. Now, what's so important about this, if we watch this break coming across and we're lifting up, technically speaking, is they're going to be out with earnings soon. And right now, Google has too many issues. Google's issues are very, very clear. They have all kinds of antitrust issues. To think that they're going to be able to control something else that is huge right now might not be the case. So you can see that a lot of people are just thinking, okay, well, they're going to have other fish to fry right now, so that's not going to be the leader. And that really leaves you with Meta. And who gets more data than Google and Meta? Not even close. And I think that's where OpenAI is going to run into a problem. That's my personal opinion on this, that Meta between Facebook and Instagram and WhatsApp and, reading all the messages that they say they don't read, they have all that data, and it's just like Google does. But Google has an issue right now and Meta does not. Now, on October 30th, they're going to come out with earnings. The biggest concern that I think people have, and I know that it's certainly one that I had, was when we were here, they changed the game and said, we're going to be a dividend stock. We're going to start doing dividend. And then they came here, oh, by the way, we're going to increase CapEx. All right. And so you're having these shifts. The issue here is that if we go from this quarter, which is after another quarter, to this quarter, and they beat expectations based upon the investments here, then this is going to go higher, especially if they start talking about the large language model. The issue that I see for all these big dogs, like the Microsofts and the Meta, is that CapEx spending is going to be significantly greater than anyone thinks. I think that Meta is going to spend way more money than people think. I think Google is going to spend way more money than people think. And I think Microsoft's going to spend way more money. Actually, Goldman came out with a statement this week that the CapEx numbers for Microsoft that are on consensus are significantly lower than where they need to be. And it boils down to the same thing. Who's going to win? Well, you have to buy product. Well, who are you going to buy product from? You're going to buy a product from Oracle. You're going to buy a product from Now. You're going to buy a product from IBM. Okay? You wanted to talk about swing trades, long-term thinking. This is how you need to think. You have to connect the dots and go, well, what widgets are you going to need to buy to create the widget that you want? You need NVIDIA. There's just no way that you don't need NVIDIA. And this takes us into the next part of this. Now, in front of you is a historical percentile skew called a call skew, volatility. And what's interesting about this is that you're at the 10th percentile. And you'd be like, okay, well, what does this have to do with NVIDIA? If your call skew and volatility is towards the low end of the range, which this technically is, they don't really care where the VIX is. Okay, the VIX might move higher, it might move lower. But if your call skew is like this in the volatility, it makes sense to buy calls. And this is what you're seeing in the video. You're seeing a lot of people going out there and buying December calls, March calls. I am not one of these guys. I was a registered options principal for 9 years. And I just tell you this. Going out there and looking at option sweeps without knowing what you're looking at is a disaster. Knowing what to look for in option sweeps, I should probably do a video on it. Knowing what to look for is a game changer. If you know what to look for, it's an absolute game changer, and you can do exceptionally well with it. We had a really nice trade the other day on some of the video calls, which we bought off that pattern, the dragon pattern I went over. And one of the reasons for it was the pricing of the options. But also, I was solidified by watching what other people were doing because I knew what option sweeps to look for. Hopefully that makes sense. If you want to see a video like that, let me know. Maybe it's something that I could create. I don't know how much demand there's going to be for me to give a lesson on gamma and skew and things like that. So your comments are always appreciated. This is from Spot Gamma. Probably, I think it's a decent product. I have no affiliation with them, but you need to know what you're looking at. And I think this is where they lose people. They lose people that are not like the option nerds like myself to some extent. Option skew is very low. Okay, you want a low skew. Currently below 90% cone. So you can see the cone right here. All right. Offering a rather cheap way to play further upside in the video. One way to use low upside skew is replacing longs with cheap upside calls. Okay, this is what people are doing. We've been doing this for some time, buying November, now we're out to December on them, and we're probably going to go out and start looking at some probably 2025s as well. And I have a ton of stock on as well. But it does make sense when you have something like this and the skew is so low to start looking at putting calls on, which then also puts some pressure on NVIDIA to go higher. I hope that makes sense. As always, comment below. I find your comments very helpful. It does tell me which way to go with things. So do you go out there and buy the stocks? I'm not sure that you do. I'm not sure that all cycles are going to be the same. I do think that you can rally. I think it's more the individual names that you need to focus on. Remember, when you came through 01 and 02, in that time period, there were certain names that lifted. And I'm not telling you not to trade. I mean, I'm pretty aggressive in trading myself on the day side, but it's 25 to 35% of what I do. It's certainly not everything. And the big winners that I've had, they're swing trades and long-term trades. So I wanted to go through that. Something like Tesla. I mean, this is really where I see a lot of people, struggling. And I want to point something out. Even Tesla, like this was a dumpster fire floating down the river with a bunch of raccoons. It just was. I'm sorry, guys. Even Elon came out and issued a statement saying, well, usually my time frames 50% are early, 50% are late. I've never seen him deliver anything early. So it is what it is. I'm not knocking the guy. I'm drinking coffee. He's sending missiles to Mars or rockets to Mars. And, I get it. And I'm not knocking it. I mean, I think that it's a lack of focus, quite frankly. But if I was to look at this is an outright debacle. You lost long-term investors on that call. There's no doubt about it. You had a bunch of robots that came out, and then you just basically had dudes walking behind them with a remote control, like, PlayStation remote. Like, okay, thanks, man. But, and then someday we might have a product. But I'm not saying to not trade this stuff. But what I see a lot of people doing with these kinds of things is everybody's in the same trade. So when you're trading options, I'm going to go off on a tangent. When you're trading options, you're trading the same thing as everybody else. You have to ask yourself, if you're doing the same thing as everybody else, is everybody winning? And the answer is usually no, right? So you're really looking at buying calls when you're down here, not on these breakouts on these names. I bought calls down in here on this. And candidly, there were so many people in the trade. I was explaining that hardly made anything for the amount of risk that was taken. I'm not trying to buy these for like $1 and then sell them for like $1.20 or $1.30. That's exhausting. So you want to watch the moves that you're doing. And this was a really good example of it where you kept waiting for this stuff to go higher and it wasn't. And that's going to take me to something else that I don't think a lot of people are fully grasping yet. So, you watch this kind of breakout with MSTR and people don't really understand this trade and they don't understand and they're saying, oh, I'm going to go buy coin. Going to get exposure that way, or I'm going to go buy Block, or I'm going to go buy Mara, right? Those kinds of names, okay? It's not going to work. I'm going to explain why. You're better off buying Block because Block owns a large percentage of MSTR. You can go look at the holdings. I think it's one of the top 3. But I really want to go through this because I think it's very important for people to get. You don't look at this and say it's too high. You could look at this and say, I'm breaking out of a range. I don't buy breakouts, right? Everything is language.
and how you talk to yourself. And I'm not going to get into this whole, mental aspects of trading right now, but I want you to get that, right? All you're doing is observing. This broke out. Do I play breakouts? Yes or no? No, I'm not buying that. The idea of evaluating this thing and the way that people are doing it, they're not getting it. And I'm just going to walk you through what he's actually doing. He actually has infinite money if you think about it. Every single time that he's issued a convert, he sold them for pennies. 1%, 2%. So now you're getting this huge push out, right? And if you think about this push, let's just look at the volume for a second. See the volume spike? What he does is he goes out there and he pitches this. Go listen to any podcast that he does. He's the hedge. He tells them, I'm your hedge. Short me and then go out there and buy Bitcoin, because we're trading at a premium to Bitcoin. And what people don't understand is that premium to Bitcoin is the reason why it's going higher, because people are shorting it. So you have the people that are buying the converts, and I'm going to do this very, very quickly. If you have a convert, okay, and you get, this is your convert price. Let's drop this down. If you have a convert and your convert price is, let's just say, $459, and you get issued the bond, and the bond's at $397, when you get issued your convert price up here and you're getting 2%. As soon as you get over that, let's just say you get to 480, you're shorting, locking this in and keeping your profit. And you're doing it over and over and over again. So you're picking up 4%, but you're trying to do it at like 3 to 1 or 4 to 1 against the convert. So you're picking up 4% times 3 or 4, 12 to 16%. Your limited partners are very happy with you. Okay, he can go to the market anytime he wants when I say unlimited money and do a convert. And then all he's doing is going out there and buying more Bitcoin, right? That's all he's doing. And then by doing that, he's actually pushing the price of Bitcoin higher, which makes this, and he's not doing enough to make it scarcer, but he's doing enough to make the price go higher when they see it happening. And then it's a cycle that's been repeating itself over and over again. So the point of this is understand why something is happening, understand why MicroStrategies could still go higher, and then make a decision on whether or not you want to do it. But don't tell yourself that something is too high and start looking at things from a valuation standpoint, unless you're going to be a value investor, which is totally cool and I wish you the best, but this probably isn't the video for you, right? What we're trying to do here is to develop themes and make money. I would watch one of these two videos if you're interested in the swing trade process that I went through. Either one of these videos can be utilized in any single time frame. That's it.